Hello, I'm Chip Stites, and this is the Laughing Retirement. Every so often, we do a market update. The reason I do it is because markets change. And while there's a ton of news out there about this is bad and that's good and this is doing fine and that's not, I think it's hard to separate the wheat from the chaff sometimes. So, the objective of this is to break things down in a simple manner so that you have the ability to make some reasonable decisions. The first thing I'm going to do is share screen here. Now, this is our market update. And we're going to take a look at sector results and a kind of a squeamish bond market, because there's a difference between the personality of the guy who buys a bond and the personality of the guy who buys a stock. And we're going to talk some more about that. But first, let's take a look at sectors. Over the last 30 days, this is what, according to Charles Schwab's sector results, this is what the sectors look like. Now, if you're looking at it, you can see that utilities and real estate are at the bottom. And you're going to see that utilities and real estate have been at the bottom for a while now. That's partially because of rising interest rates. Now, utilities and real estate tend to use a lot of borrowing. Utilities particularly borrow on the short end of the curve, and often real estate investment trusts borrow on, and REITs and mortgages are all on the longer end of the curve. In both cases, interest rates have been rising. So it's easy to see that those two sectors are going to get hit worst. Now, this is a 1-year result. And if you look at 1 year, you'll see something that's entirely different. First of all, information technology, communication services, industrials, and energy are all doing very well. Healthcare is doing okay. Materials are doing okay, and consumer discretionary is doing okay. But there's a disconnect here. And that disconnect is an important little piece of information that you might need to understand. Now, if I go down to consumer staples and I look at the last year, consumer staples are down 3.12%, but consumer discretionary is up 2.06. Now, most of that loss in consumer discretionary came from the month before, because in the 30-day yield, consumer discretionary, which was the third highest, lost 2%. So if consumer discretionary is still up 2%, it was up 4%. It was doing very, very well until this last 30 days. But consumer staples is not doing well. And if you do a little reading, what you're going to find is that the average consumer has begun to buy non-brand consumer staples. Why is that? Well, they're trying to save money. And yet, at the same time, consumer discretionary, which is the wealthier people being able to spend money on things they don't need but want, that's why it's called consumer discretionary. You have a discretion or a choice as to whether or not you want to buy it. Consumer staples, you don't. You got to eat. So while Kellogg's is down, if you look at consumer discretionary, much of that, luggage, et cetera, is up. So what we are to glean is that there's a separation between the haves and the have-nots in terms of how they are spending their money. The haves are continuing to spend at a wonderful rate, and that's good. That helps the economy. The have-nots are trying to take care of their money and spend less, and therefore they're buying off-brand cereal instead of Kellogg's. How do I know that? Well, I own Kellogg's. So the difference in what is happening right now as a squeeze is put on the middle class is that people are spending less and less or trying to scrimp a little bit by not buying brand names, not buying things that are as well known. Now let's take a look at the two side by side. Now, this is communication services. It's doing well, but after the last month or so, it was at 20%. In the last month or so, it was up 4. Energy was up 2.9, and over the last year, energy is up 6. So energy is also holding its own during this time. Communication services, it's holding its own, but communication services was up 4 in the last 30 days. So it is also holding its own. Now, what does that mean for us? Obviously, you know that the last 30 days hasn't been so great. And this could be a short-term deal or it could be a longer-term deal. But there's one little piece of information in there, interest rates, that makes it rather interesting, at least for me. And so I want to go talk about that because you all know that the markets have fallen in the last month or so. I don't need to tell you that. You also know that communication services and information technologies has held up kind of well. You also know that energy has held up kind of well for the time being. You also know that in the last month, the two that were down, which is real estate and utilities, have added 2 more. One is financial and one is consumer staples. That's why this is interesting, because in order to save money, people getting pushed by interest rates, what they are doing is that they're buying off brands. Now, let's take another look at this. Friday, there was a 30-year Treasury auction. Now, a bond buyer is a little bit different than a person who buys stocks. The bond buyer is inherently a little bit more pessimistic. The bond buyer wants to know that he's going to get paid. He wants to know how much he's going to get paid. He wants to know how long he or she is going to get paid. And he doesn't want a whole lot of doubt about it. The person who buys a stock believes that everything's coming up roses. Things are going to be good. I believe this stock is going to go up. So stock buyers are more optimistic in general than bond buyers. Now, what happens when you have a disappointing 30-year auction? Well, what does that mean? Well, it could mean that all the bonds that were offered weren't sold. It could also mean that the interest rates, in order to get people to buy the 30-year bond, interest rates were pushed up. So when interest rates get pushed up, mortgages get pushed up. And mortgages are pushing up towards 8%, and that pushes down the housing market. And the housing market makes up somewhere between, depending upon how well the housing market is doing at the time. In 2008, it was as much as 27% of the market. Right now, I believe the number is closer to 17 to 20. And so if the housing market gets squished, the economy also gets squished a little bit. Now, I don't know whether we're in a recession or not. We usually find out that we're in a recession a quarter after we've been there. And we usually find out we're out of the recession a quarter after we've already been out. So the long and the short of this is that if you own mutual funds, this is not so good. It's a little bit better if you own passive indexed ETFs. You're a little bit better off. This is a buyer's market for stocks. And if you're reinvesting your dividends and you're buying dividend stocks, and that's what your focus is, that's what our focus is, then your dividends are being reinvested at lower stock prices, which means that when the price of the stock goes back up again, that's a good thing. Also, you should know that one of the reasons we count on dividends is that dividends are more consistent all the time than prices are. Prices go up and down and up and down and up and down. Nobody knows where they're going. But when you buy something like AT&T, and I know they're having a hard time, or Verizon, I know they're having a hard time, or Donegal Group Insurance, or Kellogg, or any other company that has paid a dividend for a long time, you're more likely to continue getting that dividend than you are to have the stock price continually go up. You can count on that dividend more often than you can count on what the stock price is going to do. So when you get that dividend and you're reinvesting it and the market goes down, you're getting more shares than if the market was going up. That's in your favor over the long haul. Okay, that's the short-term stuff. Now, what's the long-term stuff? Well, the long-term stuff is that right now there's a disconnect between consumer discretionary and consumer staples. We've already talked about that. The disconnect is that the people who have money are spending it. That's a good thing. The people who have less money are being more and more and more careful with it. They aren't buying a Kellogg's, they're buying an off-brand. This bodes continued difficulties for utilities, real estate, and consumer staples. This is likely to continue. Are we going to have a recession? I don't know, but I do know this. If I had a choice between a mutual fund and a choice between a company that was going to pay stocks or had paid stocks for the last 25, 50, or 60 years, I'll take the company that's paying a dividend. I think I said a company that's paying stocks. That's not what I meant. I meant I'll take a company that's paying dividends in a down market. Now, this is going to be, I believe, a buyer's market for stocks. This is going to be a good time to make good choices about dividend paying stocks. So take care of yourself. Take care of your portfolio. Know how much risk you are taking. The point here is simple. The less risk you take, the more consistent your returns are going to be. Warren Buffett didn't buy the hot stock. He bought the lowest price, best, most consistent deal he could find. Mr. Buffett's done pretty well. That's what we aim to have in the Laughing Retirement. Consistent returns with less risk so that you don't have to worry about losing your money. If you like this video, comment below, push the like button, subscribe to our video series because we have a lot more coming. Go to our Facebook group, The Laughing Retirement. Join us, where we'll talk about retirement, we'll talk about investments, we'll talk about a lot of things. I'm Chip Stites, your host and creator. Thank you.